The Kroger Company, or Kroger, is an American grocery retailer, the largest supermarket operator, and the fifth largest overall retailer by revenue. Over the last decade, shareholders of Kroger have been rewarded substantially with market-smashing returns and double-digit dividend growth. In today's video, I'm going to take a closer look at the company, why I believe this is a potential compelling investment for dividend growth investors, and establish a fair value and good entry point into the company's stock. For full disclosure, I do own shares in Kroger. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could do me a favor and smash that like button and subscribe, keep up with future videos. This helps us out more than you can imagine in bringing you quality dividend investing content. Headquartered in Cincinnati, Ohio, Kroger was founded all the way back in 1883 by Bernard Kroger, a son of German immigrants. Mr. Kroger is credited with the creation of the successful low-cost self-service grocery chain model that persists today. And today, Kroger is a massive company with over 2,700 grocery store locations across 35 states, with nearly 1,600 of those locations having fuel centers and over 2,200 of those locations having pharmacies. And they even have 252 walk-in medical clinics. Kroger has private label brands that are offered in their stores, usually at a discount to the major brands, giving these products a competitive advantage on their shelves. And with this, they have a large network of 33 manufacturing facilities, such as dairy farms and production plants, and they've upped their technology game with Kroger Pay and a delivery network. Now, from my own personal experience, we have the Kroger-owned grocery store called Smith's in my region, along with Albertsons and Walmart Market. And Smith's is the standout easily of the three main chains, with the cleanest stores, the widest selection of products, and the best customer service. Prices are on the higher side when you compare them to a Walmart, but I prefer shopping with Smith's for the quality. Their private label products are decent, the bakery and the deli are both top-notch, and the produce is usually good. And I live out in the middle of the desert, so produce is good produce. It can be difficult to come by. Now, Kroger is a great company, and they're looking to become even larger as they are currently attempting to merge with Albertsons. We've published a video earlier in the year with more details on this. At this time, I'd say it's 50-50 whether the merger actually completes. They're going to need some allies on both sides of the political spectrum to make this happen. But if this does happen, the company is going to become an unstoppable grocery powerhouse, allowing them to better compete with the likes of Amazon and Walmart. They would be the third largest retailer overall. And look, no one knows what 2023 is going to bring, but if we were to face a recession, this is exactly the kind of stock I want to own. Kroger is going to thrive in a recession as they sell the products that we require to live our lives. You're going to go grocery shopping, every week or however often you go, regardless of what the economy's doing. Now look here into Kroger's investor relations packet. Kroger aims to generate an 8 to 11% return to shareholders every year, with a 3 to 5% earnings growth year over year, and 5 to 6% back between dividends and share buybacks. Now, Kroger has a total 5-year return of 84%, which easily beats the S&P 500's total return of 56%. Zooming out even further, Kroger has a total 10-year return of 316%, which destroys the S&P 500's total return of 217% over the same time frame. Kroger has been a compounder. Over the last year, returns have been pretty much flat. It's had its ups and downs between it all. But here we are, only a few dollars off of its 52-week low. And compare that to the S&P 500, which is down, still about 20% for the year 2022. The one negative thing I see in Kroger here is their debt. And share buybacks are likely going to have to be put on pause while the company reduces its debt burden with this planned acquisition. This would just be a minor bump in the road. I still see the long-term potential here ahead with Kroger, but I would like to see this debt become a little more under control. Everything else is quite solid. Right now, Kroger is trading at a 10.7 PE. This is about the lowest we've seen in the last 5 years, and it's about 15% below its 5-year average of 12.6. This is one indication of a potentially undervalued stock. That PE is also looking quite appealing when compared to the consumer staples sector average PE of 22.2. Right now, shares of Kroger are yielding 2.33%. This is about 14% above its 5-year average of 2.06%. When buying a company, we can lock in a better starting yield when we can get it trading above its average like this. So this is another encouraging sign. And the dividend they pay is one that Kroger can easily cover with plenty of room to continue its growth, taking up a mere 25% of earnings and 36% of free cash flow. Simply Safe Dividends gives us a safety score of 71, and in their merger literature, the company states they plan to continue paying and growing this dividend. Kroger features a 15-year track record of paying and growing its dividend at double-digit rates. The 5-year average annual growth rate is at 12%, and its latest dividend increase was at a stunning 24%. You're not going to find many in the consumer staple sector with this kind of dividend growth. Kroger pays in the months of March, June, September, and December in the amount of 26 cents per share every quarter, for a total annual payout of $1.04 per share. Revenue growth is nice and steady. We've gone from $96 billion generated in sales in 2013 to $146 billion in 2022. Shares outstanding have also been on a steady decline. In 2013, there were 1.07 billion shares outstanding, and at the time of publishing, as we enter 2023, we have 732 million shares outstanding. And I love seeing companies like this buy back their shares regularly. It provides more value to us as shareholders. So just about everything is looking good. Let's get out my valuation spreadsheet and try to determine a fair value and buy price for Kroger. Now look, I have several different valuation models I use. Not one is perfect. So what I do is I take the average of them. I get Graham's valuation, a dividend discount model, or the Gordon growth model, a discounted free cash flow model, then I take a couple relative valuations based off historical dividend yield, historical PE, and then I factor in the average analyst price target. And I take the average of these to determine a fair value for the stock, and then I can apply a margin of safety to come up with a good buy price. All right, folks, here's my valuation spreadsheet. I'm putting in the ticker here of KR, and it gives us our share price at $44.62. Entering the annual dividend of $1.04 gives us our 2.33% yield. And I've also entered in a forward PE of 10.7 and a forward earnings per share of $4.15. First, for Graham's revised valuation, I think this is becoming less useful as interest rates rise, but I'm still including it for now. I'm going to assume a growth rate of 5%. I think this is fairly conservative for how they've been growing. Current yield of the 20-year AAA bond is 4.9%. And as these rates go up, the lower these valuations are we're going to get from this particular model. By Graham's revised evaluation, we have a fair value of $44.72. Next, let's look at the dividend discount model, also called the Gordon growth model. The historical 5-year annual growth rate of the dividend is 12%. Going forward, I'm going to be a little more conservative. I'm going to go with a dividend growth rate of 7.5%. That seems a little more sustainable in the future. We have to consider this could slow down for a couple years with the Albertsons acquisition as well. Now, using a 9% discount rate, this gives us a fair value of $74.53. So even with this conservative growth estimate, this is looking really good from a dividend perspective. Now let's move along to a discounted cash flow valuation. Here I've assumed the same growth rate of 7.5% and a 3% perpetual growth rate and a 9% discount rate, using the current free cash flow of about $1.9 billion and factoring their outstanding shares at 732 million. The estimated fair value for this model comes out to $53.91. For the next valuation, this is a relative valuation based on its dividend yield. We determined that Kroger would be trading at if its dividend yield was at its 5-year average. The assumption here is that things often return to the mean. And by this metric, if Kroger was yielding its 5-year average of 2.06%, it would currently be valued at $53.47. And let's look at the PE mean reversion valuation. This is simply calculating what the current price would be for Kroger if it was at its historical 5-year PE, or if the PE reverted back to the mean. Another relative valuation, and the historical PE is 12.6, while its current's at 10.7. If Kroger was trading at this price to earnings mean, it would be valued at about $52.29. And finally, I'm going to factor in the average analyst price target, and Wall Street sees this as a $53 stock with nearly 20% upside from current levels, $53.47 to be exact. So factoring then all this in together, I believe Kroger's fair value is estimated at $55.40, which is 24% upside from its current price. But please don't assume my assumptions are correct. I could be way off on some of my assumptions here. or a calculation could be wrong on my sheet here, Let's say we want to find a good buy price here based on a margin of safety. If we assumed a 10% margin of safety, we're looking at $49.86 as a target buy price. And if we want a 20% margin of safety, we're right there. It would be at $44.32. So we're just a few cents off of that. And if you need a 30% margin of safety, we'll have to drop down to $38.78, which is a few dollars below its 52-week low. But we don't know what 2023 holds. It's very possible that we could go there still. Now, I've been dollar cost averaging Kroger in our public YouTube portfolio and have a few shares there. I also have been buying it in another account whenever it dips below $45. That's sort of my sweet spot for Kroger. I think under 45, near that 20% margin of safety, we're getting a great value for Kroger stock. But always please do your own due diligence. It's hard to deny the appeal of the stock given the uncertainty of the market, the generous dividend growth track record, the sector that it's in. I think this is just one of the top companies to watch for 2023 for serious dividend growth investors. So if you're interested in following along with the new portfolio I'm building up, or if you want to learn more about dividend stocks and some of the strategies I use, please consider subscribing to the channel. It costs nothing, but helps me get out the word tremendously. If you aren't subscribed, please be sure to do so. We have more content coming in 2023. And if you aren't following me on Twitter, please check me out there at DivGrowthIncome, and let's connect. Thanks for watching. Until next time, guys, keep investing.